Awesome. I think we can begin. Now, good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris. I'm the Marketing Manager at Genghis Capital. The weekly investor briefing takes place every Monday from 9 a.m. and it's the perfect complement to our Genghis Weekly cross-asset strategy that we share with our clients. At Genghis, we want to give our clients actionable insights and trading recommendations to actually help you in the investments and to take out the guesswork from the entire process. Shortly, I'll hand over the session to my colleagues in the research department to take us through the different segments. Gerald will take us through equities. That's the shares listed on the NSE. So that should be very interesting. And then Churchill will take over and guide us through fixed income. So we're talking about treasury bills and bonds. So before we begin, I'd like to draw your attention to how you can participate in this webinar because it is interactive. You'll find the Q&A button on your screen. So feel free to use that at any point during the session to raise any questions you may have, and we'll attend to them at the end of the session. There's also a chat function that we welcome you to also drop your comments, your thoughts, or any suggestions you may have. So really love when you guys join us in this conversation. So I know I'm excited to hear what week 39 of 2020 has for us. So Gerald, kindly begin.
Thank you, Damaris, and good morning all. Let me share my screen. So I'll begin with a weekly recap of last week in terms of the performance of the market. I think last week we saw some bearish sentiment with both the NASI and NSE 20 indices shedding 0.4 and about 1.5%. And when you look at the turnover levels last week, they increased about 112%. And this was basically because of a large trade in Safaricom on Thursday, where foreigners are very keen on the stock on Thursday. And participation also from the foreign end was about 77%. I think this is sustained from about 75% in the previous week. And then net inflows still persisting over the recent weeks. Last week it came in about 823 million shillings. I think the previous week was about between 200 and 300 million shillings. But however, if you look at the foreign flows, these are mainly onto one stock, Safaricom. Last week they had a foreign inflow about 1.1 billion shillings. And this basically tends to skew the entire market foreign flows. So as much as the market seems like foreigners are keen on the market generally, I think it is only one stock that they are very keen on, and this is Safaricom. Because when you look at the performance, the foreign performance of the other stocks, is basically they are still exiting on most of the counters. So last week they were buying heavily into Safaricom and KCB. KCB was marginal. But they sold. They still continue selling on most of the counters, but the key counters that were selling was Equity, JBL, and Stanbic. So on Equity and JBL, I think there was a trend. I think in August and a part of September, there was a trend whereby they were heavily buying into these key stocks. I think right now they are more focused on profit taking, and then come back to that cycle again. So the top traded counters are still the key counters in the market, Safaricom, KCB, Equity, and JBL, basically the strong counters that we have at the NSE. So in terms of where we are currently trading compared to the peers in the African continent, I think our market price earnings is very attractive, 9.6 times. Sometime back, we went through on how to read the market P and also the div yield. So compared to the African average, our market is very cheap, and this definitely is one of the key things that foreign investors usually look at when they're doing the asset allocation in both emerging and frontier markets. So 9.6 times price to earnings compared to the peer African average of about 13 times, very attractive. Div yield 5.3% compared to African average of about 4.5%. Again, the higher the dividend yield, the better, the better that investors can get from our market. So these are very attractive levels, and we see this being a key attraction point for foreign investors when they start looking at for frontier markets across Africa and other frontier markets. So in terms of ideas for the week, we're still, in the long term, we're still very biased towards stocks that tend to be at performance in terms of earnings growth, stocks that tend to be strong in terms of their balance sheet. And when you look at for a specific stock that you are keen at this week as a recommendation is Kenya Reinsurance. I think when you look at the price to book level of Kenya Reinsurance, about 0.1 times. We consider this to be a deep discount stock. So a deep discount stock is a stock that basically trades at a very steep discount to a value metric. For example, in this case, if you look at the net cash per share, which is a value metric for Kenya Re, it is about 2.77, and the share price is about 2.2, about 2.2, 2.3. So net cash per share, in this case, we are looking at what the cash the company has. Then you add the bank balances, and then you also add the liquid assets. For example, in this case, we have used the treasury bonds. So those are the basically what we call near cash assets. So if you add those up, you'll get a value about 2.77, and compare that to current market, then we are looking at a very deep discount stock. So net cash per share, again, does not include other assets, for example, properties, and we know insurance companies tend to have a very big portfolio of their assets in properties and other assets that insurance usually focus on. So at these levels, 0.1 times at a price of 2.23, very deep discounted stock. Again, when you look at Kenya Re performance as at half year, I think PBT, that is profit before tax, was up about 50%. I think that was one of the best performance from the insurance sector compared to most of the other insurance companies. So basically from across the sector, we saw performance basically flat. I think it was Jubilee that was slightly up. Most of the others did not perform well. So despite all the challenges and what investors usually tend to discount on the Kenya Re, we think that it is a very good stock for long-term investors to look at based on its discounted value. So another recommendation for this week, we are looking at Centum. Its dividend register is closing on 2nd October, and we are proposing, we do not, for investors that are keen on a dividend strategy across the market, what we're saying is we do not recommend a dividend strategy on Centum. Basically, we are looking at an attractive dividend yield of 5.7%. I think most of the stocks that usually heavy dividend payers are currently 8 and above 10%. So we do not recommend a dividend strategy despite the books closure getting closer on 2nd October on Centum. So corporate calendar is, as you can see, books closure. Basically, these are books closure dates. Centum 2nd October, Kenya Re 9th October, KenGen 22nd of October. So investors who are keen on the stocks should note these closure dates. I think given that some of these stocks are still keen on dividend this year, and we do not expect most companies to be giving a dividend this year, then investors who would consider cash flow that can be key on some of these stocks. So basically, Sepil could take us through the next session, and I thank you for your time.
Thank you, Gerald, for walking us through the equity segments. Let me share my screen. Okay, so as usual, I'll walk you first the macroeconomic commentary as I get into the fixed income recommendation for the week. To start us off, yes, on Friday, Kenya Gazette issue was about revenues and net expenditures as at end of August. So this data usually is posted with a lag of 3 weeks, a month. So that data came out in the Kenya Gazette issue of Friday. And just look at the revenue segments as a starting point. Cumulatively, in terms of tax revenue for the first 2 months in the current financial year starts in July, was at 188 billion. And if we narrow down to the month of August, that was 93.5 billion that was collected in terms of tax revenue. For non-tax revenue, that was 350 million thereabouts. So total was 1.74 billion. Domestic borrowing, as per that report, I came to 121.7 billion as at the month of August, and there were some external loans and grants. So in total, cumulative revenue to fund the budget, excluding appropriation in aid. So what I mean by appropriation in aid are, say, things like public unis. For example, the current financial year, they expect to have a budget allocation for totaling 100 billion, of which 50% is coming from issuance from Treasury, and the other 50 is now their own generated internal funds. So the internal generated funds are what is called appropriation in aid, but that is excluded in this report. So in total revenues as at end of August, it was 370 billion that was collected. But we normally square in particularly the tax revenue and the non-tax revenue, which collectively are called ordinary revenue. So if we get onto the expenditure side of the equation, that's the other side of the coin. Screen tends to freeze on Mondays. Just a second. There it is. Okay, yeah. So in terms of the net expenditure, what was spent in the first 2 months of the year, financial year, and in particularly for the month of August, in terms of recurrent expenditure, think salaries and wages, think operations and maintenance. For the month of August, that was 104 billion, thereabouts, of which around 73 billion of that amount was wages and salaries to the public servants. Consolidated fund services, this is where the public debt comes in, public debt servicing comes in, pensions and gratuities, and also salaries and allowances and miscellaneous. Salaries and allowances to constitutional office holders, that's the president, the vice president, and constitutional offices like the DPP, Independent Policing Oversight Authority, and other commissions. So they are paid under the Consolidated Fund Services. So anything under Consolidated Fund Services is what is called a first charge of the budget. So for example, we see that the total in the month of August was 63 billion. So out of the revenues that we were able to collect in the month of August, first we need to sort out consolidated fund services. So public debt, these are interest on the domestic bonds and external bonds, and also maturities of domestic bonds or any loans that are maturing, both domestically issued and externally issued. So in aggregate, the total amount that was paid in the month of August, that was 64 billion, of which public debt, interest, and also redemptions was 54 billion. Just getting into the development exchequer, there was a marked improvement from the 1.5 billion that was paid out in the month of July up to 37.7 billion in the month of August. Issues to county government, we all know what's the stalemate in Senate in regards to the county allocation revenue bill, and that is issuing from the third basis of revenue allocation. So that's where the standstill has been. So we haven't seen equitable disbursements to counties in the current financial year. But having said that, there was some arrears that were not that occurred in the last financial year ending June. So it was around 29 billion that was still pending. So that out of that amount, 26.2 billion was paid out to counties, at least to meet some of the salaries, if I'm not wrong. So what is the input of this? Because this equitable share revenue for the last financial year was not put into equation in the July. So what it means that even the net domestic borrowing for the current financial year went up by another 29 billion. But I'll speak more about it in the later slide. So cumulatively, we are seeing that 320 billion has already been spent in the first 2 months of the financial year, of which 231 billion was spent in the month of August in particularly. So if I may get to the fixed income review, last week's T-bonds performance, we saw overall turnover was around 15.5 billion. So that was a 27.3% decline on a weekly comparison. Most of the bonds that were traded were what we call the on the run infrastructure bonds. Basically, the recent infrastructure bonds, particularly those which were issued this year, the 9-year infrastructure bond that was issued, I think, around April, and the 11-year infrastructure bond that was issued last month. Those were the infrastructure bonds that accounted a significant chunk of the trading activity last week. And also there were some pockets of trading activity in the 5-year space and the 15-year tenors. We saw some robust activity in those segments of the yield curve. Just a commentary about weekly T-bills. Overall, CBK, of course, comes seeking 24 billion on a weekly basis. But last week it was 16.9 billion, which was received. That was a performance rate of 70.4%. And just looking at where the yields, as at the end of last week, closed at and vis-a-vis the start of the month of August, we are seeing that yields on average between 91-day T-bill, 182-day T-bill, and 364-day T-bill have increased by 0.1% since that period. So we are seeing that there's been some gradual uptick in the yields, reversing the trend that we saw in particularly between June and July, where yields on the T-bills was coming down. So this is also an opportunity for investors who like to say park some of their monies as they still watch out for opportunities. They might now even consider T-bills at the moment. And in particularly, we've seen robust activity in the 91-day T-bill in the last 3 weekly auctions or so, whereby even out of the 4 billion that is sought, bids that is received and accepted is over and above that 4 billion mark. So getting on to the last net domestic borrowing. So we estimate that as at the end of last week, net domestic borrowing was 269 billion. And if you factor in the overdraft facility held at CBK, that comes to 272.8 billion. So comparing with the initial net domestic borrowing target that was up in the initial approved budget, that was 494.3 billion. So that is 54.5% already has been achieved in under 3 months. So that's, we see that Treasury is ahead of the curve in terms of its domestic borrowing program. But then again, if I may now bring this issue, last week in the Kenya Gazette issue that was published last week on Friday, we are seeing that net domestic borrowing has increased to 524.7 billion. Remember, initially it was 494.3 billion, but now Kenya Gazette issue say that it has gone up by 524.7 billion. So this ideally the increase is around 29.7 billion is coming from it's coming from the counties, disbursements to counties, because there's a legislative framework around it, and because that is not there, so the only route that Treasury can be able to disburse monies to counties is to have increased net domestic borrowing. So that is what panned out over the course of August, as seen from this Kenya Gazette issue report. But that said, draft 2020 budget review outlook paper, or in short BROP, is seeing an increase in net domestic borrowing by 60.3 billion. If I may take you back to last week's presentation, whereby we saw that the revenues, Treasury is reducing the revenue target in the current financial year by 110 billion, of which that has to be offset by an increase in net financing, of which 50 billion will be from external sources and 60 billion from the internal, or rather net domestic borrowing. So that's where the increase from 494.3 billion up to 554.6 billion is issuing from the draft 2020 BROP report. The final report should be out next week, around 30th of September, but it also has to be approved by the cabinet. So right now we're at a point whereby for sure we are seeing that even the net domestic borrowing will edge upwards, either to 554 billion as seen in the draft BROP, or also an additional 580 billion net domestic borrowing in the current financial year. And ordinarily, what this implies is, in normal circumstances, net increase in domestic borrowing simply implies that even the yields will start going up. And by yields, I mean, or if I may take you back to one of the webinars that we did, yields is basically the coupon that an investor receives as a percentage of the bond price. So if yields increase, basically means that even the bond price will come down. And this, of course, issuing from supply and demand dynamics, whereby if there's a supply of something and the demand is not, or rather the demand is not matching that supply, the price of that will come down. So that is one of the things that pushes even the yields to go up. But right now, another function that you're seeing is also the liquidity in the market. How is the liquidity trends in the market that will also perhaps tell us that yields will go up, be it in the T-bills or be it in the T-bonds in the near future. So if you compare between, I usually go back to June and July period, whereby we saw significant amounts of liquidity. But that said, we are seeing even the liquidity trends has somehow normalized in the last 2 months. So perhaps even going forward, with this kind of increased net domestic borrowing, it will be a challenge for the government to raise its borrowing target. But that said, even looking at where we are at this point in time, Treasury is still ahead of the curve. So I still expect there could be some latitude from Treasury in terms of the monthly issuance that will be coming forward, still to be aligned with the medium-term debt management strategy, which basically is more skewed towards longer tenor issues. Just to look at the results of the primary bond that came out last week. I know a number of you have had a chance to look at this. And out of the 50 billion that was sought by this government or through CBK as the fiscal agent, 81.7 billion bids was received, of which what was accepted was 64.2 billion. And the second last column shows what was the accepted yield, and the last column shows the eventual price if you convert that accepted yield to the price per every 100. And we see that the last paper, the one that was had 45.7 billion accepted, it's priced at a premium. Basically, to take you back, a premium is if the accepted yield or if the yield is lower than the coupon, that bond is at a premium. And the reverse is true. If the yield is higher than the coupon, the paper or the bond is priced at a discount. So there's a premium on the last paper, but the two papers, because compared to relatively comparable bonds which have higher coupon rates, those two bonds are priced at a discount, but the last paper was priced at a premium from the primary bond auction results. So just to close this week's trade, we are still taking you back to the 11-year infrastructure bond that was issued last month. We are still seeing some liquidity in this paper. And even right now, this paper, which when it was brought into the market, when it started trading in the secondary market, it was at a discount, but right now it's hedging closer to the par price of 100. So we recommend investors to consider buying it at 10.85% to 10.9% levels in the course of this week, over and above any other paper that investors are eyeing. This is our week's recommendation. So let me stop it here, and Damaris, you can take it from this point.
All right. Thank you so much. Thank you so much, Churchill and Gerald. Churchill, maybe you could mute your mic for me. So now, thank you so much. It was really nice to see some familiar faces back for the webinar, and we really do love the questions that have been raised. So we have a few in the chat and in the Q&A, so I'll address them in the order they came through. So Margaret, a familiar face, we're glad to see you. She asks Gerald, why is the Mauritius price to earning ratio so high? I believe this was in your presentation. At the same time, we have Brian and Mark asking similar questions. They want to know the long-term stocks or counters that an investor can actually put their money in. So Gerald, I think we could answer those two questions first before we move to the rest.
Thank you for the good questions. Yes, Mauritius, the price to earn is about 48 times. I think that was basically a short-term distortion in the PE. Because on average, when you look at Mauritius, the P is about between 15 and 20 times on average, historically. And this is in line with most other similar countries. You know, as much as we talk about Mauritius as an African country, it's usually closer to what I'd call emerging market country, not a very good comparative of African countries. This definitely is due to its tax haven status, the business environment. There is much better compared to most African countries, and its PE ratio is usually a bit higher compared to the usual SSA countries. So I think that is a short-term distortion, but this should smoothen out in the future. In terms of other long-term recommendations, yes, I think banks currently are trading at very good multiples. That is in the financial services space. As much as they have rallied, I think sometime back when they were close to the announcement of their earnings, banks like Equity Bank and KCB were trading at 30, 28 shillings. As much as they have rallied now to 35, 37 shillings, I think they still offer some good value for a long-term investor. Definitely currently, there's that whole issue about provision levels and what is going to happen in the economy. But in a long-term duration, this is definitely going to even out, and earnings should start picking up in the future. For other stocks, I think ABL is also trading at good level, as 160 shillings. Yes, they'll be affected in this year, maybe also in the half part yes, this year, and most likely stretching into the early part of next year. But if you look at post the pandemic that you are currently having, then there's definitely a case for EABL. I think the price at current levels are prices that we have not seen, definitely factoring in the current environment. But longer term, the market share is still there. Guys will continue taking beer, and this is going to be reflected in their financial performance subsequently. So another strong stock, but with a caveat, I think current pricing is still quite high. Safaricom, it's one of those stocks that you cannot miss in your portfolio. You look at Safaricom, it's a unique case in the Kenyan NSE market. Half of the market capitalization in the NSE, growth much faster than most other stocks that we have in the NSE. And also when you look at their products, they are always innovating, coming up with new products around the M-Pesa ecosystem. So definitely the business is investing a lot in terms of its future growth, but I would like Safaricom at better prices than current levels of about 30 shillings. So those are the key stocks that I would look favorably in terms of long-term recommendations. Most are trading at good levels currently. Safaricom definitely at better prices than current levels. I would highly recommend. Thank you.
Thank you so much, Gerald. Margaret, Churchill has added a macroeconomic perspective to the question about Mauritius. We'll move to the next set of questions. We have Silas who asks, what would you recommend with 100,000? And if I could be so bold, let me address this question. I think, Silas, the best next step would probably for you to engage with our client relations department or our wealth managers, and they'll be able to help you decide what kind of stocks, or rather, what are you looking for? Are you a short-term investor? Are you a long-term investor? And with that kind of information, they'd actually be able to recommend for you the portfolio that would work best for you. But if you've attended our previous session, we have talked about our different portfolios. We have a momentum portfolio and we have an income portfolio. So again, based on the kind of returns you're looking for and your appetite, they'll be able to advise you. So Silas, you can reach out to us on info@jenges-capital.com. Now, Joseph Njoki, in the Q&A had asked, your Jacuzzi app has been showing practice investing for the longest time and coming soon. How soon is soon? I took the opportunity as we were having the presentation to actually engage our alternative channels and technology team. And it is work in progress. There is no definitive timeline at the moment, I'm afraid. So the best thing is just to keep interacting with us, keep using our app, and you'll be able to know when that practice module goes live. All right. The next questions, let's direct them to Churchill. We have Benji who asks, expectations for yields for bonds in the coming period, what are they? So Churchill, perhaps you could answer that before we move to Morris's questions as well. Alas. So Churchill is having some, okay, to explain the expression stuck on his face. So Churchill is having some connectivity issues. So I think we'll come back to him as he sorts them out. I think they're signs of life, but let's give him just a moment. We can go to Morris's question. Gerald, this is you. Churchill will come back. So Gerald, Morris is asking, you mentioned 0.1 as the price to book ratio for Kenya Re. So he wants to know, what does this mean in terms of the dividend percentage yield? And he also notes that the government of Kenya has a stake of 60% in Kenya Re, and the market tends to treat companies with a large government stake harshly. So can Kenya Re be considered as an income stock for a long-term buy? I also noticed there's another gentleman in our chat. Let me just pull him up. Yes, Chege Mwangi. Chege Mwangi also is asking you, Gerald, why are you recommending Kenya Re as a long-term buy? So, Gerald, please enlighten us.
Okay, thank you. In terms of Kenya Re, government stake, yes, there's always that worry. But if you look at the value currently, as much as we're talking about the risks of having government as a large shareholder in the business. On a net cash per share basis, net cash is basically like I'm telling you, give me your 10 shillings and I'll give you 8 shillings back. It, it can't, it usually doesn't make sense, right? So as much as there's that worry and issues with government owned entities, but when you look at the value basis, the value proposition of the business, and then also on the growth side of the business, then there's definitely a very strong case for Kenya Re. Talked about the net cash per share, about 2.77 shillings. So basically, if you strip out all the other assets, properties, insurance assets, and just remain with cash, that is basically the cash that we have, the cash in the bank, and also the fixed income instruments, basically government bonds, those tally up to about 2.77 shillings per share, right? But the current market price is about 2.3, right? So it's like cash, the market is discounting that cash that the business has. So it definitely doesn't make sense. So in terms of the dividend yield, as the 0.1 represents a dividend yield of about 1%, 5%. I wouldn't say that, I wouldn't recommend Kenya Re as an income stock because, when you look at income stocks, you're talking at yields of about 8%, 10%. And then also the payout ratio must be, quite high. For companies whose yields are above 8% and 10%, we are talking about payout ratios of over 70%. We have also some like BAT that has a payout of about 100%. And this is not a one-off payout ratio, but it should be consistent, for example, in the last 5 years. So over the last 5 years, we want to see a company that has a payout ratio of about 70% and above. And also the dividend yield must be in the region of 8 to 10%, which where government securities currently are at. So I wouldn't recommend Kenya Re as an income stock, but I would recommend it as a value stock. Value stocks are discounted stock compared to their book value or another metric or measure of value. I hope I've addressed your question quite well. Damaris?
Thank you, Gerald. I believe you have, but I think all attendees, if you do want to have a follow-up conversation, you can reach out to Gerald and Churchill on their email address, which is research@jenges-capital.com. So Churchill, I see movement, so I'm going to assume your connectivity issues are sorted, so we can get back to Benji's question. Benji was asking about expectations for yields for bonds in the coming period. I know you had touched on it during your presentation, but maybe you can restate it for us.
Thanks, Damaris, for that question, Benji. And as I said, right now, all of this is dependent on even the one of them is now the net domestic borrowing trajectory. We know that in between any given budget year, there are usually some revisions. Hence, we are seeing that there could be either an increase of by 60 billion or 80 billion. But in normal circumstances, this increase usually implies that yields will go up, basically as the investors start saying that perhaps the government is desperate for money. But right now, we are not in a normal situation. One of the first things to back that is the fact that right now, the government has already borrowed 54% of what it intended to borrow in 12 months. That has been achieved under 3 months. So even going forward, I think it will have some latitude. But that said, I think domestic, there's a maturity, there's a bond maturing next month and also in December. So even the GOK will be issuing even in the next couple of months, it will also have to factor in that there are some maturities that have to be sorted out. But that said, looking at the liquidity trends, this is majorly on account of banks accounts to 55% the domestic bond holdings. So depending on liquidity trends at any given point, it also dictates or it gives us a pulse of where bidding will be. So, for instance, if government is seeking 50 billion in next month's issue, and liquidity in the banking system foremost is quite constrained. So there's a higher likelihood that even that 50 billion that the government is seeking may not even be sought. So that's also a function of yields. But just to circle back, we are saying that on the bond segment, we look at it in more or less three different segments of the yield curve. There's what we call the short end part of the yield curve. That's anything maturing 5 years and below. There's now the medium term between 5 years up until 10 years, and then 10 years up until 3 years. So the short end of the curve, that's where most of the activity or most of the trading activity happens. And there we saw yields have more or less declined from end of June up until now around 0.3% on average. In the medium term, on average has been around 0.1% from end of June up until now. And long end of the curve, anything above 10 years to maturity up until 23 years, that has been quite stable, not much activity in terms of yield movement. So in terms of yield predictions, we are still seeing that that part of the yield curve will be more or less steady even going forward the next 3 months. That's where our horizon could be, realistic horizon could be. We're still seeing even the yields will still be stable at that point. Same with the medium term. And in the yield curve, in the short end of the yield curve, we expect some reversal just based on the liquidity trends are somehow normalizing from where we were end of June, end of July period. So we expect some uptick in yields at bonds that are having 5 years and below to maturity. I hope that has answered the question.
I'm sure it has, and if it hasn't, they will hit us up again. So we're coming down to the last two questions. I have one from Peter Maina in the Q&A, which I believe I can answer myself. So Peter is like, probably this may not be share related, but hopefully you got answers. This is in reference to your Haba Haba account, which I applied via Jekuze app. How do I access the account? So Genghis Capital is a holistic organization. We have our investment bank that, of course, handles the things we've been discussing, shares and fixed income. But we also have our asset management side that has an account called actually Hele Mara. Now, Peter, what you're referring to is our Haba Haba challenge for our Hele Mara account holders. If you've applied for the Hele Mara account via Jekuze, you should get an email that has notified you that your account has been activated within 3 working days. Once your account is activated, you'll be able to log back in, and then you can actually navigate to Unit Trust, Hele Mara. Then you can now buy units into the fund, which is basically saving or depositing into your account. Now, if you want to take part in the Haba Haba challenge, Haba Haba is just to try and get people into the habit of consistently saving their money. So instead of putting your money in a savings account or somewhere else where it doesn't give you the kind of returns that our fund can, it actually allows you to consistently develop that habit, and then you grow your money over time. So our current yield is above 10%. Now, Maina, if you still have not gotten an email within these 3 working days, I'm going to send you the email address, marketing@jengis-capital.com. Please chat me there your email address, or I can refer to it, and then I can look into the matter. So I hope that has helped. Now, I have Emmanuel, who says that he wants our opinion on Centum as a value investment, and also wants to know what price is KQ likely to be sold at. So Gerald, those are for you. David wants to know, this joint East Africa share trading platform that excludes Kenya. Any insights? Anything that brings more tradable securities is a good thing? Why is the NSC not on board? So Gerald, I feel like this is your field. You can definitely answer David. And then Brian asks, can you have two CDS accounts? Now, Brian, you can't have two CDS accounts if you have two identifying documents. So let's say you open a CDS account with Genghis Capital using your national ID. Then you go to another stockbroker. I don't know why you go to a different stockbroker, but you go to a different stockbroker and open a CDS account with them using your passport. So that's the scenarios under which you can have two CDS accounts. So let's answer those questions. Gerald.
Yes, thank you, Damaris. In terms of KQ, I think the most recent communication they had is that they're working on valuation in which the minority shareholders will be taken over. But this is still a process that is ongoing. I would be speculating if I tell you that I expect that they'll offer 3 shillings or 4 shillings. But given that previously they communicated that it will be at a premium to the market price that was there, then I think there's definitely going to be an upside for investors who have those shares in comparison to the price that existed before the stock was suspended from trading. Yes, Centum. Yes, there's been a lot of talk, even from management, about boosting the price to book of Centum, which has been trading at a discount compared to the market price. I think the most recent was about increasing the dividend payout ratio, but this is something that we'll definitely have to see. As a value stock, I would be a bit skeptical in terms of recommending it as a value stock, given that recently they have adopted a new strategy that is more geared towards growth, shedding off most of the legacy businesses and looking at growth areas, mostly real estate. So I would want to see how that real estate strategy works out before I would consider it as a value stock. So as a value stock, I look at metrics that are what I call deep discount. For example, on Kenya Re that we have just talked about, I'm looking at I'm stripping out all the assets and just remaining with the assets that are just cash. So if you strip out the assets of Centum and remain with assets that are just cash, then I don't think it reaches the threshold of being called a deep value stock. The other question was about yes, the integration of ESC markets. I think there was an issue back. I think it was in 2015 when this discussion started off, and Kenya talked about show a bit of dissatisfaction in terms of how the process will be carried out. But I think we are waiting to see communication from NSE in terms of how they are going about it, or if it is still something that they'll consider. I think it will be good if we all join into an ESC market, because even from the foreign end, when they are looking at markets in Africa, they tend to see that our markets are so fragmented. They are very small, even for position taking, due to their large assets portfolio. I think if you look at Safaricom, for example, in Kenya, as much as we talk about Safaricom in Kenya as a giant, from a global perspective, Safaricom is a very tiny company, right? So there's always that push by foreign investors to have markets that have more weight, and we could definitely see them start looking favorable if this is something that is going to work out efficiently and smoothly. So 2015, NSE had raised some worries in terms of how the process was going through. I think they talked about a vendor in Pakistan, how he was chosen. I think that is the most recent highlight I saw. But I think it's something they would want to also consider as the market, as basically the process gets through. We have all been talking about ESG integration. I think this is positive, and definitely NSE wouldn't want to be left out in that process. Thank you.
Okay, I think we're coming towards the end of our session. We just have 2 more questions to go, and one is housekeeping. So Gerald, I think we can finish up with Maurice's question, and then I'll answer Jim Wangi. So Maurice is asking, analysis of momentum, income, value stocks were always in the previous Jengis Weekly cross-asset strategy issues. Will this return on future issues? So Gerald, did they drop off the report? Will they come back?
Yes, these are still there. If you look at our equities page, I think that is in page 2. We have our portfolios, the momentum portfolio, the income portfolio, and value portfolio, and how they have been performing. So we always have this. It is still in the weekly report in terms of performance. On a quarterly basis or half-yearly basis, we usually have a report that details these portfolios, the components, and the reviews that we have had, and also the allocation. So this usually is reviewed on a quarterly basis, and it's something that we are looking to do during the next quarter. So performance still in the weekly, still there. Actually, the portfolios are performing quite well. I think they are all ahead of the value, the momentum and income portfolios are ahead of all benchmarks in the Kenya equity space. The value stock is performing quite well compared to NSE 20 industry. So those portfolios, they are a key part of our equity strategy, and we usually don't leave them out in our reports. So they are still there.
Okay, awesome. Thanks for that, Gerald. So the last question is actually, okay, before then, Emmanuel, I hope you've seen Churchill's contribution to the discussion as well. So the last question really is just housekeeping. This is from Jim Wangi, who's been having some challenges on our Jakuza app. So the first thing is we will follow up with the team. I have the email address that you use for the registration for this webinar. So the same I've been trying to confirm from Brian Otieno if it's the same. I'll just use that and engage Michael and see if we can close this by today. Now, your recommendation of just having a way that the app keeps you logged in the entire time for use, it's a cybersecurity concern. It's just like if you use either your ABSA app for banking or your KCB or your Equity Bank, whichever retail bank you use, the app typically logs you out after some time of use, the same with internet banking. So the reason why you have to keep logging in, even if it's tedious, is just for that security aspect. We don't want anyone else who might use your phone to accidentally go into your app, sell some shares you didn't mean to, or buy some stocks you didn't want to, or deposit funds. So it's just a cybersecurity issue. But the matter about the activation of your account, we'd definitely look into it. So I've taken note. We have Peter, Brian, and Jim Wangi who need feedback from us. So team, Emmanuel, thank you so much for the compliment. We really appreciate our returning attendees. We also appreciate anyone new who has joined us. This session takes place every Monday between 9 and 9:30. Thereafter, we engage and we answer all your questions to the best of our ability. So let's meet next week, Monday. The last thing is that you will receive an email saying thank you for attending our session. That email will also have a link to our YouTube channel that has this particular recording. So if you just want to refer to something or see the presentation again, you can easily do so. And as you visit and watch this video, we'd really appreciate if you subscribe to our channel so that you stay updated with our content. We do intend to upload more videos that address some of the terms and some of the aspects that we discussed during this session. So be on the lookout for that as well. Thank you so much, everyone, and we will see you next Monday. All right, have a good week.